Every November, the IRS quietly releases new contribution limits for retirement accounts, and it changes how much money you can shelter from taxes that year. Most people never plan for it. But if you're trying to build real wealth while working a normal job, knowing exactly what's official versus what's still being projected could mean the difference between a rushed decision in January and a clear plan you execute through December. In the next few minutes, I'm going to show you what's confirmed for 2025, what the IRS is projected to announce for 2026, the specific strategies that most people completely overlook, and exactly when you need to act. Pay attention to this part because the math compounds hard. If you're saving for retirement at any level, bookmark this. One of the things almost nobody talks about is the gap between official numbers and projection. Here's what's actually happening. The IRS publishes contribution limits based on inflation adjustments, and those announcements don't always come when you need them to plan. For 2025, the official numbers are locked in. For 2026, we're still waiting on the IRS to announce the exact figures, but based on historical inflation patterns, we can make educated projections. Let me show you the difference, because it matters more than you think. Starting with what's already confirmed for this year. Traditional and Roth IRAs are sitting at $7,000 if you're under 50. If you're 50 or older, add another $1,000 for the catch-up contribution. That's official right now, published by the IRS. For people covered by a workplace plan like a 401k, the income thresholds where you lose the ability to deduct traditional IRA contributions are already set. If you file as married filing jointly and have a workplace plan, your deduction phases out between $126,000 and $146,000 of income. Single filers see the phase out between $79,000 and $89,000. For Roth IRAs, the income limits are higher because Roth contributions aren't tax deductible up front. Married filing jointly phases out between $236,000 and $246,000 and $246,000. Single filers between $150,000 and $165,000. These numbers don't change year to year much, but they're the guardrails that determine whether your contribution actually gets the tax benefit you're planning for. This is the part nobody notices until tax time. Now for 2026, the projections based on typical inflation adjustments suggest a few shifts. The employee contribution limit for 401k plans is likely going from $23,000 to $23,500. IRA limits are projected to jump from $7,000 to $7,500. HSA limits, which almost everyone underutilizes, are expected to rise from $4,150 to $4,300 for self-only coverage, and from $8,300 to $8,550 for family plans. But here's the critical part. These are not official yet. The IRS typically announces the final numbers in early November each year, and we're still waiting on the 2026 numbers. If you lock in a savings plan based on projections and the actual number comes in different, you might miss out on tax benefits or overshoot your contribution limits. This is where patience and flexibility matter. Let me show you the real impact of these numbers stacking together. Reset your thinking here, because most people calculate retirement savings wrong. If you and your spouse are both 50 years old in 2026, you're looking at some serious contribution capacity. Each of you can put $23,500 into a 401k, and if your plan allows another $7,500 as a catch-up contribution, that's $62,000 combined. Just in your 401k, each of you can contribute $7,500 to an IRA plus $1,000 for the catch-up, which is $17,000 combined. Add a family HSA at $8,550 if you have a high-deductible health plan. You're looking at $87,550 in tax-advantaged space that year. At a 24% tax bracket, that's approximately $21,000 in federal tax savings in a single year. Over 30 years with an average 7% return, that compounds to roughly $88 million. That number doesn't mean you'll have $88 million in retirement, but it shows why every $1,000 of contribution capacity matters. The system is designed to reward people who max it out early and let it grow. Here's something most people don't realize: the RMD age already changed, and it affects your planning window significantly. The Secure 20 Act moved the required minimum distribution age based on your birth year. If you were born after June 1950, your RMD age is now 73 instead of 72. If you're born after 1959, it climbs to 75, but that doesn't take effect until 2033. What this means in real terms is that if you were born in 1953, you don't have to start pulling mandatory distributions until the year you turn 73. That's 3 extra years for your money to compound tax-free inside a traditional IRA. 3 years of untouched growth at 7%, turns a $500,000 account into $612,000. That's an extra $112,000. You didn't have to pull out and pay taxes on. This shift alone is why knowing your exact age threshold matters. Now let me close the first loop I opened here. What changes everything? Most people think they understand retirement contributions until they hit an income limit or miss a deadline. But here's what almost nobody knows. The math works completely differently depending on whether you have access to a workplace plan, whether you're married, and how much you make. A single person making $160,000, who's covered by a 401k at work, can't deduct traditional IRA contributions anymore. But they can do a backdoor Roth conversion, which lets them contribute $7,500 anyway, and convert it to tax-free growth forever. Except, and this is critical, if they already have money sitting in a traditional IRA from years past, the backdoor Roth gets partially taxed due to something called the pro rata rule. This is where people lose thousands. They didn't know they were vulnerable to losing. A married couple with combined income of $240,000, both covered by workplace plans, is completely phased out of traditional IRA deductions and approaching the Roth phase-out too. Their solution is different. They use Roth 401k contributions instead, which have no income limits. But they need to understand this before January, not after they've already filed their 2025 taxes. This is the part that separates people who leave money on the table from people who capture every tax break they qualify for. Let me show you the specific strategies that work. Strategy number 1 is something most people miss entirely. Roth conversions before required minimum distributions begin. Here's the window: you reach age 50 and you're still working. No RMDs yet, but you're getting close to 73. If you have a traditional IRA sitting with pre-tax money, you can convert portions of it to Roth in lower income years, especially the year you retire before Social Security and RMDs kick in. The sweet spot is filling up the bottom of your current tax bracket without spilling into the next higher bracket. If you're married filing jointly and your taxable income is $150,000 right now, the 22% bracket goes all the way to $211,000. That means you have $61,000 of conversion room at the 22% rate. Convert more than that and you jump to 24%. Most people don't see this opportunity because they think conversions are complicated, so they never look for them. Strategy number 2 is hiding in plain sight for married couples' spousal IRAs. If you're married, even if your spouse has zero income, they can have an IRA as long as you have earned income. You can contribute $7,000 to your account and $7,000 to theirs, which is $14,000 total. If you're both over 50, that's $16,000. The phase-out rules are different for spouses too. If your spouse stays home and isn't covered by a workplace plan, they don't get phased out at your income level. But if you're the one not covered by a plan and your spouse is, the phase-out starts at $236,000 of married filing jointly income. This strategy works silently for couples where one person works higher income and the other handles caregiving or part-time work. Strategy number 3 is the mega backdoor Roth, and it's not talked about nearly enough. Most 401k plans let you contribute $23,500 as an employee, but the total limit is much higher, $69,000 for people under 50 and $76,500 if you're 50 or older. The gap between what you contribute and the total limit is employer matching, typically $5,000 to $8,000. And then after-tax contribution. Many plans allow after-tax contributions up to the limit. If your employer matches $5,000 and you contribute $23,500 as an employee, you still have about $33,000 of after-tax contribution room. That after-tax money, when converted immediately to Roth, becomes tax-free forever, including all future growth. But here's the catch. Your plan has to allow after-tax contributions and either in-service distributions or in-service conversions. You need to call your HR department and ask directly, does our plan allow after-tax contributions and conversions? Most people don't ask, so they miss this legally available shelter. Strategy number 4 is HSAs, which might be the most underutilized retirement account that exists. An HSA is triplet tax advantaged. Contributions are tax deductible. Growth is tax-free. And withdrawals for medical expenses are tax-free. Unlike FSAs, the money rolls over year to year, and there's no use it or lose it deadline. The pro move is maxing your HSA contribution, paying your medical expenses out of pocket, and letting the HSA grow for decades. You keep receipts for any medical expense you've ever paid out of pocket, and in retirement you can reimburse yourself for those expenses, tax-free, even if the expenses happened 30 years ago. If you max the family HSA at $8,550 every year for 30 years at 7% growth, you end up with approximately $860,000 that's completely tax-free for healthcare and retirement. Most people treat the HSA as a current year healthcare savings account when it's actually a long-term tax shelter. If you have the income to pay medical expenses separately. Now here's where it gets real. Timing matters more than most people understand. There's a difference between knowing these strategies exist and actually implementing them before deadlines pass. You can contribute to an IRA for 2025 until April 15th, 2026, which is your tax filing deadline. But if you wait until April, you've lost the compound growth of almost 4 months. January contributions grow through the entire year. April contributions grow 11 months less. Over decades, that difference compounds into real money. For 401k contributions, you can make catch-up contributions for a prior year. Those have to happen during that calendar year. So if you're 50 now and turn 51 next month, you need to set up that catch-up contribution now, not wait until next year. The common mistake is thinking you have more time than you actually do. Here's another mistake that costs people money: the 6% excess contribution penalty. If you contribute more than the limit allows, you pay 6% of the excess amount every single year it sits there, even after you withdraw it. A married couple thinking they can each put in $10,000 to an IRA instead of $8,000 because they're over 50 doesn't cost them $800 in extra taxes.